From a long-term view, there is a stable recovery stemming from two double bottoms. Within the minor bearish retracement from August to September, there are some of the most compact forms of the double top and triple bottom patterns. The swing points are composed of reversal candles separated by one candle. This highlights how smaller components of technical analysis, like candle patterns and swing points, are the primary components of larger and progressively more advanced concepts such as chart patterns. The steeply declined head and shoulders could be disregarded if strict criteria of a symmetrical outline is applied. In any case, an accelerated downtrend is halted to begin 2011. This stems from a compact double bottom. It benefits by being in the same approximate support range as the triple bottom. Not surprisingly, a later downtrend is reversed at the established support range that is bolstered by the intersection with the longer-term uptrend lines. This even leads to a double bottom reversal. In November, there is technically a compact declined triple top. The final downswing is not so clear, due to it being composed of a large real-bodied green, then red candle. In fact, instead of a full third downswing, the same general price action of a downswing is represented by a bearish engulfing pattern. The effects of the minor declined triple top are less apparent, since bullish influence is retained at the established support range, intersecting with the lower uptrend line for greater support potential. Stronger support potential leads to the larger uptrend continuing, and a shorter-term bullish acceleration from an ascending triangle. Once again, the smaller triangle is the favored and theoretically correct outline of an ascending triangle pattern in a bullish continuation context, rather than a bullish reversal context. Here is a less common case where it is more helpful to reference the long-term uptrend line rather than the uptrend line from the ascending triangle. The short-term spike of bullish volatility on January 10th put doubt into the completion of the double top. However, the following 5 days reaffirmed bearish sentiment for a more definitive break of the lower boundary, in addition to lining up with the last sizable downswing to form a spread-out triple top. Additional bearish context comes from past clear swing points, including the older declined triple top. Despite clear downswings developing a likely double top drop near the established resistance range, it was crucial to wait for a conclusive break of the lower boundary. Interestingly, the failed double top stems from a minor double bottom rather than just a sharp upswing. Even though this double bottom doesn't have a first neat upswing, the overall outline from the real bodies of candles is neatly contained within the bullish reversal range. The double bottom even finishes with a classic green surge to end April. Despite the drastic proportions, there is still a stable incline marking the neckline of general head and shoulders price action. The resulting downtrend is also quite stable, since a pair of downtrend lines neatly crosses a series of downswings on a shallower angle. The descending trend lines even intersect with a concave triple top to repel an uptrend from an inverse head and shoulders. A volatile spike in late June is also repelled, and the brief trading over the trend lines can be considered the upper wick of a bearish star if the candles are combined in the highlighted red range. A failed triple bottom accelerates the stable downtrend lower, in a classic bearish continuation of large-scale 3 methods falling price action. Naturally, there is greater resistance potential from the downtrend lines, intersecting with the resistance range marked by the failed triple bottom. However, there was actually some stronger evidence of a bullish recovery prior to the current bullish acceleration. This is outlined by the exact opposite of what was seen in the first half of 2016. There is strong bullish context in a developing uptrend from a head and shoulders reversal that is immediately countered by a double bottom. Here is another example of a very compact double top. It begins neutral to increasingly bearish after the harami forms the first downswing area. Later, there is another double top to outline a wider flat top range with a slight concave feature due to the two middle downswings being lower. This is not exceedingly important, but an unusual feature to note. When the larger downtrend is reversed, it is by the ubiquitous double bottom. This is a more moderately sized double bottom, but the upswings are clearly derived from neutral to bullish short-term price action. This is shown by the flatter trading before and after the first upswing, which stems from a harami. Then the second sharper upswing centers on a bull hammer. As usual, uptrend lines can be helpful if a bearish reversal range develops at established resistance. Here is a classic bullish continuation with large-scale 3 methods rising price action. Interestingly, it doesn't have a completely horizontal lower boundary for the resting phase range. In fact, it is a strict reverse head and shoulders outline, though it is of course out of its theoretically preferred context of being a bullish reversal range rather than a bullish continuation range. Whether it is a reverse head and shoulders or a normal horizontal range in a bullish continuation, the key feature to watch is a break of the flat upper boundary, which clearly takes place in December. The end of 2019 could also have been considered a strict ascending triangle that highlights the current failing range of support. Here is a classic case where a firm support will likely be breached given the heavily bearish conditions. These conditions mainly comprise a sharp peak followed by a descending triangle formation that fittingly has an established lower base of support. It takes into consideration the close proximity of the old ascending triangle range. As would be expected, the ascending triangle's base offers firm resistance. Then when the uptrend begins to make more progress into mid-2020, there is an important bullish surge right after the main outline of the descending triangle is passed. This is where the heavier resistance is theoretically concentrated. The descending triangle then becomes a helpful reference for support as a bearish retracement takes place prior to the more gradual resumption of the uptrend. This case study tended to focus on compact pattern outlines to highlight the connection to smaller scale analysis with candlestick charting. As well, there were great examples of some less common conditions, mainly with asymmetrical head and shoulders outlines.